This is King World News. I'm Eric King, and you're about to hear an interview with John Case. This is a man who's on his way to managing $1 billion. He is extremely well respected in the industry, and what he had to say and the warnings that he issued about the United States and the monetary and fiscal situation will stun some of the listeners around the world. Be sure to go to our homepages. We've had so many articles on the trading in global markets this week. But without any further delay, here is John Case. Joining us now is John Case, portfolio manager at CI Global Asset Management. John, I wanted to talk to you about the bigger picture. I know that you guys have a big global macro view on where we are, why gold is going higher, and some of the other investments that you're involved in. But talk to me about the big picture of what you guys are looking at, not the noise, but the big picture of what you see as the reason to own gold.
You think about why you might want to own gold to protect against systemic risk to your wealth. It's really all about fiat currencies and the potential for a sudden or gradual reduction in your purchasing power long term. Now, that sounds like inflation, but it's really monetary debasement. Inflation is really just a symptom of debasement. So large investors, we're talking central banks, pension funds, sovereign wealth funds. Ultimately, the fiat currency I'm talking about is the U.S. dollar. 70% of worldwide private assets are U.S. dollar denominated, and that's a function of its role as the world's reserve currency. And so that's really what the focus all comes down to is U.S. dollar inflation and gold acting as a hedge against, the potential negative impacts from those two factors. I get asked questions about, okay, well, what's the risk to the U.S. dollar? What's the risk of inflation? The biggest risk, in my opinion, to fiat currency really is debt. And I get asked the question, well, why how does tie that together? Why does debt impact fiat currencies? When a government borrows in financial markets, it does so from people like, me and you, Eric. And ultimately, that money is not around those savings to otherwise finance private investment, factories, computers, R&D. And long term, what that does is lower future GDP growth. And that's been going on for like 50 years. It's been going on for a while. So the debt that we're laying on now, it's not only is it a layer of bricks on the boat as far as the debt that needs to get repaid, but it's also lowering the ultimate GDP level that we can create, right? Because it's stealing from the future, right? So, back in the 1980s, a unit of debt used to create about 60 cents of GDP output. Today, that's 24. So you're seeing that trend down in GDP, that lessening of impact that debt has. You're getting less and less fire from $1 of debt in terms of GDP. So more credit, really, this is a structural problem. More credit. It's not really helping. We get short-term bursts of activity, but it's the long-term tangent gets lower and lower and lower. So, we know we're spending a lot of money fiscally right now in the U.S. I think that could create kind of 1 to 2 years of maybe a burst in output. But ultimately, this is a load of bricks on a boat that's getting higher and higher. And when you grow debt faster and your economy growth lowers, debt to GDP rises, and the economic treadmill you're on as the economy gets faster and faster until someone gets thrown off the back, which is, again, back to that systemic risk hedge that people are starting to layer on bets and more insurance in the form of gold against that happening.
John, talk about that debt for just a minute, because when do you see that becoming a problem where even though the world is using the U.S. dollar, as you said, 70% of the wealth, as the world's reserve currency, it just becomes too much. It becomes too much of a problem, and the dollar begins to unwind or have some serious ramifications from that?
Yeah, I mean, that's really the million-dollar question, isn't it? Right? Like, when is it a bridge too far for investors? We can look at where we are now. We can make some comparisons about, historically, what's happened at those levels. Annually, we've taken the U.S. Congressional Budget Office data. So this is the U.S. government's own internal projections of debt. And we've just presented to clients, just, unaltered, and just really put forth what the U.S. income statement looks like. So a lot of our clients aren't really aware of the level of deficits. You hear about it in the media and you read about it, but to actually see the numbers is quite shocking. And we've been warning our clients, back to 2018 that, even if you take the Congressional Budget Office projections, which, by the way, have historically been wildly over-optimistic about revenues and about tax revenues. So they're always underestimate the actual deficit that actually comes to pass. Even then, they're projecting 5% annual deficits that would take debt to GDP from 100% to 125% by 2028. So this is 2 years ago, we were looking at a 10-year forecast. And 125% is when we saw Italy tip over, right? So that's, that for us, that was okay. We're at a flashing yellow, and flashing red is coming in the next, then it was 10 years. Now it's 8 years away. If we look at fast forward to today, so 2 years has passed, we're at 106% debt to GDP, a little bit higher than they estimated because some of the tax cuts lowered, federal government revenues. And we've gone to 126% debt to GDP this year, in 1 year. It's phenomenal. It's phenomenal amount of the debt that they've stacked up this year in response to COVID, obviously. But even if you assume GDP came back up to pre-COVID levels, you'd still be at 123% debt to GDP. So just right on the nose of where Italy was. We know what happens next in the historical context when you have too much debt. We know it's a problem. I don't know when it's going to become a problem for the U.S. I mean, U.S. does have that status as a reserve currency. It's, obviously the strongest economy in the world, best country from a growth standpoint, strongest military. So it's not Italy. And I'm not trying to say it is Italy, but it's still a country that at some point debt will cause the full faith of the U.S. dollar and the opinion of foreign investors to get eroded, right? We know from 900 years of history what happens with fiat currencies, and we know how governments historically have delevered. And at some point, private capital is going to sniff that out and do what they always do, right? They seek to protect themselves. How do governments historically and always, I would say, delever? They can cut they can cut spending or raise taxes, what we call austerity. This preserves the purchasing power of loans, right? You're helping out debtors, right? You're making sure that when they get their money back, they're getting the real value back, real value of their debt, real value of the currency that they lent out. The reality is there's way more have-nots than there are haves. Politically, the way to go has always been to screw the lenders, right? Lenders get a partial default in the form of, a lower value of the currency they're getting paid back, and that comes in the form of inflation. So, in the modern era, there's been this firewall protecting lenders because central banks are independent from the politicians who obviously want to, they're more inclined to the politically favorable avenue, which is debt jubilee and print money. We're starting to see that firewall fall, not just in the U.S., but around the world. We're starting to see politicians either coerce central banks to print or, the lines are getting blurred between central banks and governments. And so that's where we are today now. And I don't know what happens next. But, I think if you study history, we've got 900 years of financial history that suggests what's going to happen next. And it's the same whether it's 2020 or 1920, which was, the most iconic example of money printing in the Weimar Republic of Germany. And I think there's lots of parallels to what's happening today to what happened then 100 years ago.
I think the parallels are even better for the French assignat and what they went through in France, right? Because they would print money to try to get that economy going, and then it would get going for a while, and then it would roll over, and they would start printing more money and get it to come back a little bit. But it just kept printing more and more money to try to get the economy going. And as you said, we're going through that in the United States now. We're getting less bang for the buck. We're down to 24 cents for every dollar printed, and that's shrinking. And so I think the French example is maybe a little bit like the Weimar example, but I think that French example is so simple and it's so easy to look at, right, John? Because you print money and then eventually the currency collapses.
Exactly. Same thing happened in Germany. I've distilled it down to in a few years. So in 1916, the German public basically started stepping back and they were unwilling to finance the fiscal deficits. So the German central bank steps in and they start printing money and you start to see inflation inching up. Negative rates became more negative. And that, of course, resulted in lenders being not compensated for their risk. Capital leaves, the mark falls by 25%. And what happens? Capital flight, and the central bank is forced to monetize more and more of that debt. Right? That's debt monetization. Governments don't print because they want to, right? They print because to not print would cause liquidity to contract, right? As private capital steps back. So money supply goes up. You got inflation. It self-reinforces. The inflation pushes rates more negative, further discouraging lending to the government, which encourages more debt monetization. This is exactly what's going on right now. By 1917, marks in circulation have doubled, but the currency doesn't decline nearly the same amount. It's down 25%. So, all in all, not a bad trade-off. I think that's kind of where we're going right now. And then by 1919, the decline in the marks boosted the German economy. Commodity markets are flying. And by and large, politicians are pretty happy, right? Exports picking up, unemployment's falling. I mean, this is the playbook, right, that we're going through. There's even a quote from Dr. Friedrich Bendixen saying, "Don't raise taxes, transfer loans into money. That will bring us salvation." That is MMT being discussed in 1919. And that's what it was. So this MMT is not a new idea. It's been around for 100 years. But what happened after 1919 and shortly thereafter, capital leaves, the local currency crashes. And voila, the shackles of debt have been purged through inflation. Debtors are getting back 25 cents in the dollar in terms of purchasing power. So that's the scenario that gold protects against. It is a monetary asset that cannot be printed and has repriced itself in depreciating currencies for a couple thousand years. So that I think, really is ultimately, we're trying to figure out what inning we are in this playbook that I just outlined. And I think the recent rise in gold price is telling you that more and more people are paying attention to that granted tail risk, but with a small probability of happening anytime in the very near future. But I think that small probability is growing.
What are you guys doing to make sure your clients get out of this and get on the other side and they're protected? Are you going into the mining stocks, the high quality mining stocks, the mid-tier mining stocks? What are you doing? Because those are incredibly undervalued. When you look at the XAU and the HUI versus gold, they've come off of all-time historic low levels in history, but they're not that much higher. So the outperformance, I think, going forward of mining stocks versus the price of gold is going to be extremely radical in the 500% to 600% range, I think, over the entire bull market.
Yeah, no, I don't disagree. When you look at, okay, where do we want to be positioned from an asset standpoint? I think it's probably a little bit more instructive to think, where do we not want to be, right? So the playbook I just outlined is what Ray Dalio in his book on debt crisis would call inflationary deleveraging, right? The guys who get wiped out are the lenders, right? They're stuck long fiat. Much better to be gold or even equities, mind you, because equities reprice themselves. There's a proverb from poker. I'm sure you've heard it. I think everyone's heard it because Warren Buffett has used it a few times. It's, if you don't know who the sucker at the table is, it's you. And I think the biggest suckers in this market are those who are making 30-year loans to the government at half of inflation, right? I mean, every policymaker is laughing at these people. They're pumping up every other asset class other than the one they own. They're structural buyers, right? Insurance companies. But, if you're long bonds and you're an individual, not an insurance company, why? Right? I think a defendable rate is probably 4%, not 1.5%. You're picking up pennies in front of a steamroller if you think, 1% is going to save you. If inflation pokes its head up, you're going to lose 16% on repricing, on a long duration asset like that. So I think that's where you're hearing more and more smart people. I've noticed, you probably have as well, the last 9 months or so, started to call for the death of the 60-40 portfolio. It's that 40% fixed income. Those investors that I think are going to gravitate to gold. Gold equities, I think, ultimately should perform as well because they're obviously producing that asset. They are an equity, and sometimes they do trade like equities over short periods of time. Longer term, the fundamentals of the business should outshine the fact that they trade as equities over a short period of time. So cash flows matter, but sometimes not over the very short period. And I think that's what's causing the divergence right now. Right now, they're acting like stocks without recognition that the revenue line has gone parabolic. We've only seen a few quarters of that revenue and cash flow come through, and we haven't seen consensus estimates really come up on longer term basis anywhere close to spot. So you're not seeing projections for that cash flow and that earning potential to carry on. So I think that is part of the reason why there's that divergence where gold has gone up. Gold equities haven't really responded yet. But I think with the goodness of time, as these cash flows, these higher gold prices start to come through, people are going to realize that they're screaming cheap in every way. Margins, cash flow, free cash flow, even dividends, which the sector has never had. You're seeing dividend increases almost across the board over the last quarter. Something that 13, 14 years ago never would have dreamed that this is an asset class that it could ever turn into an income product. I mean, and manage your expectations. I'm not saying it's an income product now or that the yields are, something that you would gravitate to just for income, but it's been an interesting period to see how much income and how much of that free cash flow generation is being returned to shareholders in this environment. So it's all good for the gold equities. I think that divergence is short-term in nature.
Let me add that you brought up the fact that this could become sort of a dividend play. And for people who don't realize what happened, as an example, we talk about different periods in the 1970s. You can talk about Weimar Germany in the United States. You can talk about the Great Depression. During the Great Depression, when that kicked off, you had home-stake mining basically near $70. And of course, the stock market utterly collapses in the coming years. But what's fascinating is that stock goes up 800 or 900%. And by the end, by 1935, it's actually paying a $75 dividend. And you have to understand that's against a backdrop where you have had an utter collapse in stocks, an utter collapse in real estate. So the overall wealth magnification, when you cross-reference that, it's quite unimaginable for people who actually moved their money into home-stake mining and said, well, they prohibited us from buying gold, but I can't go over here and buy home-stake mining. I mean, it was really a great wealth transfer, right, John?
Oh, absolutely. Like you mentioned, homestake, right? Sort of like the negative correlation of their revenues to what's the broader economic environment. Like what a great hedge for a portfolio. The gold sector, I would argue, is the only sector in financial markets that's going to generate earnings momentum and cash flow momentum Q3, Q4, Q1, Q2, right? Like what other business is going to see, their revenues go up 20, 30% year on year in this environment? Like none.
And John, it's even more complex than that, because not only are the revenue streams going up, but what do we always look at when we're in the miners? The gold oil ratio. And that is at a level right now with the price of oil incredibly cheap. And the input costs for miners, that's the number one input cost, being 20 to 28% of overall input costs being energy. They're cash flowing like raining ATM cash money all over their shareholders and everything else. They don't even know what to do with the money, to be perfectly honest. So, typically these things end up in a mania. But without even discussing the mania and where it ends up, let's talk about a stock that you have invested in. Because as your company pushes towards overseeing $1 billion, you're not quite there. You're certainly on your way, especially as this bull market matures. You look to deploy capital in the most advantageous possible manner. And one of those companies that's run by Stephen Dean, who's extremely well respected all over the world because of his background, is Artemis Gold. But I want to know from you, why did you invest in Artemis Gold? Aside from Stephen Dean, and I want you to talk about Stephen and all of his credentials, but why? Because it is a people business, right, John?
Yeah.
But why Artemis Gold? Why did you go there? There's a lot of horses out there. Why Artemis Gold?
So look, when we initiate positions in the portfolio and we build our portfolio, there's three real drivers of alpha that we look to identify in companies that we think ultimately lead to outperformance relative to our benchmark over time. So how much cash the business generates? So it's what I call free cash flow yield, and you touched on it. Gold miners, all of them. Doesn't matter, not speaking specifically Artemis, but all gold miners right now are in a much more advantageous position than the last cycle. Because the last cycle, the gold price was driven, it was a commodity bull market, not just a gold bull market. And, you had FX for commodity producing countries flying as the oil price went and commodity prices took off, and those governments saw their revenues, obviously go up, and there was demand for their currency. So that ate into a lot of the higher revenues that gold companies produced in Canada and Australia. You had higher oil, which Canada and Australia are big oil producers, so those currencies were strong. CAD dollar went to par with the US. So you didn't see you had headwinds against your business, even though you had higher gold prices. It's a different environment today, obviously, with the with the oil price where it is, and the pressure on some of those commodity currencies. You got the tailwinds from the currency, but you don't have the headwind from the input costs. So you're seeing margin expansion at a much more rapid rate, and that's what we're seeing. And and we're looking for the businesses that have that margin, and we're starting to see that free cash flow yield, like double digits, ideally, is what we're looking for. So that's the first thing, free cash flow. And at this environment, we expect free cash flow to expand much faster than it did last bull market 9 years ago. The second thing I look for is how much value can the business or the asset generate by reinvesting that free cash flow. That's what I call wealth creation, or you might call it, in other businesses, they may refer to as return on invested capital. In the mining business, that really comes from exploration. The third thing we look at, and this is what I believe Artemis is offering, is how investors value a business changes over time, what I call risk transition. So Artemis, I was a large investor in a company called Atlantic Gold. Stephen Dean was the CEO. And, he's now the CEO of Artemis. Steve sold Atlantic Gold to Santa Barbara for, multi-hundreds of millions of dollars, made us a boatload of money in the process. When it came to starting a new company and doing it again, we jumped at the chance to team up with him because there's so few people in this business that make money for shareholders and act like shareholders themselves because they are investors, right? Most management teams have very little skin in the game, which is not the case with Steve. Like Steve is partnering with his investors. And so we jumped at the chance when Artemis launched last year. They've come out of the gates with an acquisition project called Blackwater in BC. I was doing this back in 2009 when Richfield Ventures made the Blackwater discovery, which was ultimately consolidated for over $700 million by New Gold. They drilled it off and put it into permitting then, and it's sort of been sitting hidden within that company since then. So since 2011. 11 million ounces of resource, so it's a huge project in BC. This is a big prize, tremendous value. So how do I expect to make money in Artemis? We expect the discount rate that investors ascribe to this company to drop over time, which sends the share price higher. We estimate that value, and it's not far off from what Artemis just put out in a feasibility study, as being around $14 a share Canadian, and that's at a 5% discount rate. That's what we run, $1,750 gold price deck, which I think is conservative. I think we're going we are way higher. I think we're going the opposite direction from $1,750. I think we're going north of $2,000. The 5% discount rate is at $14 a share. That's what it would be worth as a producing gold mine. It's a low risk jurisdiction. 5% discount rate would be appropriate for a producing gold mine in BC. It's trading at $5 a share right now. Right? So you might ask, okay, well, what's the disconnect? And the disconnect is the market's applying a much higher discount rate, right? Or something closer to 13, 14%. And the last thing is the potential dilution to put in a mine into production. So when I look at Artemis, you think about the risk. Okay, well, this is in BC, low risk, debt financeable. It's got major permits in place, so the time's not huge. And this is a team that can execute. They've done it in the past, and they've got that access to capital. So when I look at, okay, is this a company that can go from a 13% discount rate to a 5% over the next 4 years? I think there's great visibility on someone like Steve and his team accomplishing that and bridging that gap, and that's ultimately why we've invested with him.
John, I'm going to bring in Stephen Dean now, the CEO of Artemis. Stephen, you heard that endorsement from John Case, and he and others have made a great deal of money following you in your career. You put together Artemis Gold. People are very excited about this stock. There's tremendous insider ownership, and with you, there's always a lot of skin in the game, so people are much more comfortable following you for that reason. And obviously, you're known all over the world for your ability to execute and get things across the finish line. But Artemis Gold, talk about Artemis Gold.
Yeah, thanks, Eric. Well, essentially what we're doing here with Artemis is exactly what we did at Atlantic. The approach, the business model, the de-risking events are all but identical. And so applying that approach, at least in the case of Atlantic, released value. We had a stock performance of 1,100%. That's 11 times from the beginning of the investment in that asset through to its ultimate sale to an intermediate Australian company for $800 million in cash. Board and management owned 38% of the company then. Today, we own 42% of Artemis. It's the same team. It's the same team who have successfully built mines in the past. And that's what we're doing at Artemis. We have what we call our differentiators. One of them is that ownership piece. Another is our de-risking pieces, which is things like fixed price contracts for construction, things like project finance on a sensible basis so that you minimize your dilution to shareholders, because right now debt is really cheap, and some would say debt's free. If you can afford to take it on and service it, then that's a good way of funding capital in your business. So we apply all these differentiators. So our stock today is trading at around $5. When the NPV of the project, as John was mentioning in his comments, is around $15 to $20 a share at around $1,500 street consensus gold at the time. So if you use, say, a $2,000 gold price, which is pretty close to where we are now, the NPV of that project doubles almost. And that's the sort of leverage that a large asset will bring. So that's another reason why we are really excited about this project. We systematically de-risk and build this project. And by doing so, we take that discount that we're trading at sort of 30, 40 cents to the dollar, our price to NAV of our underlying asset, and de-risk it and take it to $1 in terms of the full dollar of NPV value. And that's a 3 to 4 times journey. And that's what we're looking to do here with Artemis. So once we've built the project, we put it into production, we've commissioned it, we've brought it in on time and on budget, then we grow it through exploration. We look at other asset opportunities, and depending on the market, if the market recognizes that value, that's great, we've done our job. Or alternatively, we look at selling the asset into this hungry, intermediate, senior producer base who are generating huge walls of cash flow right now at these gold prices, and they don't have growth. And this is a tier 1 asset in a tier 1 jurisdiction. It's what everyone wants to have in their portfolio as a producer.
Artemis Gold, stock symbol ARTG in Canada and ARGTF in the U.S. Stephen Dean, CEO of Artemis Gold, a guy who's been around the business for decades and is well known all over the world for his ability to make shareholders a lot of money. And also John Case, portfolio manager at CI Global Asset Management. Thank you for joining us on King World News.
Thanks for having me on, Eric.
Thanks, Eric.